One mistake during the mortgage process could cost you your dream home. I'm going to show you the top 5 easily avoidable mistakes that can get your mortgage declined by an underwriter. Let's take a look. The number one, and unfortunately one of the most difficult mistakes to overcome, is when the loan officer miscalculates your income. See, banks are almost always going to use the most conservative approach, so it's important that your loan officer does too. There are some rare scenarios where they may allow you to be a little more aggressive, but they're so rare that it's important that your loan officers have the bank review them and sign off on them before he issues the pre-approval and gets you shopping for a home. For W-2 employees, one of the biggest mistakes we see comes with overtime income. With overtime income, they want to have a history of receipts. Sometimes you can get away with 12 months, but they really want to see a 24-month or two-year history of having that overtime income. And then they're going to use an average, and they're going to use a worst-case average. So for example, if you made really good money this year for overtime, but then last year and the year before you didn't, they're going to look at all those years combined, and they're going to use the average of all those years, the previous 2 years and the current year to date combined, and that's the income they're going to use. If you move jobs, they want to see that there's a symmetry or similar industry and that the overtime trends are consistent. If you have a lot more overtime in the new job, well, they're still going to use that long-term history. They're going to use that average. If you have less overtime, they may not allow you to use the overtime at all because you don't see the same trends with the new position. When it comes to things like bonus income, they're going to look at why do you receive that bonus income? Is it a one-time bonus? Is it a Christmas bonus? Is it performance-based? When and how often do you get that income, and why are you receiving it? And as with all other incomes, they're going to look at the trends. Is it inclining? Is it declining? Is it steady? They want to make sure that that income is going to be received on a regular basis if they're going to use it. One big thing that I see a lot of people make a mistake with, if you get a one-time signing bonus, that money's not going to be usable because they're not going to receive it again. They want to have that continuity of income that you're going to get that bonus year in and year out in order to let you use it. Now, are you only commission-based or do you receive commission and salary? Again, we look at the histories and the trends. Are they inclining or declining? Do you have at least a 2-year history of getting that commission? Or maybe have you moved from positions within an industry, but you have at least a full 12-month history and the current year of income, of that commission income that they can average out? Because again, they're not going to let you do it if you only have less than a year's of commission income received. And as always, they're going to use a worst case. So if you had a really great year this year, but you had a rough year last year, they're not going to use that great year only. They're going to use that combination of the last couple of years and average it out. For people that may be contract employees, and this is really common, for example, with nursing, do you have that history of employment? Now, one thing with contract employees is they're going to want to make sure that there's not any gaps in employment. Now, if it's going to happen within 6 months of closing, they're going to have to justify you being able to use additional contract income. Do you have, again, that history? You're going to hear that term a lot when it comes to income. Do you have that history of contract employment? And do you have 0 gaps in employment? Do you not have a lot of lag time between or downtime between contracts? Now, for my self-employed borrowers, and this hits near and dear to my heart because, again, I'm self-employed. I know exactly how it goes. Do you have at least a 2-year history, or do you have a 1-year history combined with previous experience in the field? So, for example, I was a loan officer working for other companies before I went and became self-employed. So I could use that other previous couple of years and the 1 year self-employed income to qualify. Now, one big thing, and I see this happen a lot with different self-employed buyers, you got to be careful if you want to buy a house with write-offs. One beautiful thing about being self-employed is that you have the ability to use the tax system and write off expenses. It's a great part about being employed, and if you have a good accountant, they can show you how to be as aggressive as legally possible. But the problem is, if you write off all of your income and put it all towards your expenses, when it comes time to take a look at that income and you show maybe $20,000 in profit, even though you maybe made $150,000 or $200,000 in income, well, that's a problem because I have to look at, for the most part, what's showing at the bottom line minus a few things we can add back in. But if you've been in self-employed for at least 5 years, you can potentially, depending on the underwriting system, use 1 year of tax returns. And so what that puts you in a position to do is that if you maybe want to be less aggressive with your write-off for 1 year in order to qualify for your purchase, then you can do that. Maybe take a little bit of hit in the taxes that you pay, but you could be in the position where you can qualify for a purchase. And then the following year, get back to being aggressive and writing off as much of the expenses as you're comfortable doing. And one of the things I mentioned, you heard me talk about things I can add back in. Do you have assets? Can we add in depreciation on vehicles or different types of physical assets that you have for your business? So it kind of depends on the business that you're doing. Do you have assets you use for your business that we can write off depreciation on? Then one of the last things we're going to look at is, do you pay yourself on payroll in addition to taking profits from the company? How do you actually pay yourself? We want to make sure we look at all the avenues we can take into account because we can use that gross pay and make sure we give you credit for all of it. All right, so another major deal killer when it comes to buying a home is getting new credit lines. Banks always do a soft pull on your credit before the close of a purchase transaction or a mortgage transaction in general. So they're going to know if you've got a credit card to go finance that new furniture or if you went and got a new auto loan. Added credit means generally added debt, added monthly payments. And so they're going to make sure they take those payments. They're going to have to document the payments and add them back into your overall monthly debt. And in some situations, that could kill your file because that could put you over the debt limits and it could cost you your ability to buy. And then if you can't find that paper trail, if you have a problem getting together statements and things that can prove the payments, that can create delays in your closing, and that can cause problems as well, depending on the timeline for when you need to close that purchase. Now, the last thing is that it can potentially impact your credit score. So let's say you've been shopping for a long time and your credit report's going to expire before the end of the transaction or before the end of the purchase. They need to go repo your credit so it doesn't expire before your purchase is done. Well, if you've gotten a new credit line, sometimes that hurts your credit score, so it could drop your score, and then it could impact the loan you qualify for. It could impact how much your down payment. It can impact a lot of things. I've seen this happen, unfortunately, and so you've got to be very careful when it comes to opening new credit lines. Now, the thing is, life does happen. Sometimes cars die, things blow up, you need to go, appliances die, you need to get certain things. So before you do anything though, talk to your loan officer. We have tools at our disposal where we can take a look and see how any new credit lines would impact your credit. Have them use those tools before you end up with getting a new credit line, and that way it's not going to cost you your home purchase. Now, another mistake that I see happen that kills deals more often than it should is that you deposited cash into your bank. See, the thing is, we need to be able to have a paper trail for all major deposits into your accounts for 2 months. So what that means is no mattress money. You can't just pull some cash that you had in a safe and deposit it in there and think that you're going to use it for the transaction. So if you're planning on using some cash savings that maybe you've had squirreled away, but you're going to be buying a home, get it into the bank right away. I don't want to see it deposited on 2 months of bank statements. So what that means is you need to have it in the bank, and then you need to have 2 full statements where that money's in the bank and I don't see any movement, I don't see it deposited before we want to move forward and use that cash. Now, for things like maybe you sold an asset, I've seen it happen when people sold motorcycles or sold cars, had an extra vehicle they got rid of, things like that. We've got to make sure we have a paper trail for it. A bill of sale, for example, receipt, things of that nature. But then we need to make sure that the deposit matches the bill of sales. So we need to make sure that the money that you're putting in isn't larger or significantly less than the actual sale of that asset. The money's totally usable, but we got to make sure we have a paper trail for it. Otherwise, they won't allow us to use it. Another thing I've seen as well is maybe you work side jobs for cash. You have a second job that you work that's a cash job. Now, most of the time that money, if you don't have a paper trail, again, you hear me say paper trail a lot when it comes to depositing cash. If you don't have a paper trail for it, that's going to create problems for us. It's better not to even try to use that money. One situation where I do see it a little bit different is if you're using tip income. If you have a long history of tip income and you do eventually claim that tip income on your tax returns, we could potentially look at it. But for non-taxed income or money that doesn't get claimed, there's no real paper tracing for it, you're not going to be able to use it, so don't try. Now, one killer that kind of seems silly to me is quitting a job. Now, you could potentially move to a new job, but don't make that a surprise for your loan officer. We need to know ahead of time. But quitting a job, maybe surprise retirement, things like that can create major issues for your purchase. Again, I know this seems silly, but I've actually seen this happen a few times. Maybe your retirement, you decided, hey, you know what? Got the deal on the house. I can afford it. I want to retire now, live off of those 401ks, those investment accounts. I'm good. But you don't tell your loan officer. See, the thing is, before every transaction closes, one other thing we do is called a verification of employment. We do a follow-up. It's a verbal. They get on the phone, they physically make sure that you still work at that job. So if you've done a surprise retirement and you decided to walk away, or maybe you moved to a new job without telling anybody, we're going to find out. And then it creates a whole lot of issues of A, if you have retirement income, will you qualify with that retirement income? Can we track it? Do we have the paperwork for it? B, if you move to a new job, have you started the job already? Do we have the paperwork on how much you're going to make? Will you make enough? All of those things come into play. And then, for example, you move to a new industry and it can create even more problems. So quitting a job or moving to a new job can really blow up your purchase, and it really can cause a problem. So make sure that you don't have any surprises. Now, again, life happens. So you may come to a position where you want to retire, or you may have a great opportunity with a new position, or there may be something that pops up that may be a big change for you. That might be good for you and your family, but just make sure that you communicate with your loan officer. Make sure there's no surprises and that we can address it ahead of time. That way we don't get towards closing and try to get our clear to close and find out, oh, by the way, brand new job, retired, all the income's different, because we have to start the process all over again. And again, it could kill your deal. Now, of all the things we've talked about that could be potential mistakes, they all kind of tie into one big thing. We don't want to have surprises for your loan officer. It's one of the most frustrating things for us as loan officers to have happen is us to get surprised by a major change that we didn't have communicated by our buyers. Don't keep secrets from your loan officer thinking that you're going to be able to get away with hiding those things. We're going to have one of the most intimate relationships you're going to have with anybody that's not married to you and your family. We're going to get into your finances. We're going to talk about your credit. We're going to know all about you. And it's important that we do because an underwriter is going to dig in just as deep and they're going to find out all about you as well. They're going to get a full financial profile. So don't put your loan officer in a position where they'll be surprised or potentially have landmines that they can't address ahead of time. And here's the thing, most of those things we can fix ahead of time if we know about them. We'll know how to document them. We'll know how to address them ahead of time so they don't create problems. Don't put your loan officer in a position where they have a major surprise that they can't solve or they have to backpedal and you miss closing deadlines or potentially cost yourself a purchase or your home. And we talk about surprises, we're talking about, okay, hey, you have a second job or some self-employed job, maybe a little company that maybe you're writing off a lot of expenses on, so you have a little bit of a loss on it. What we do is we want to make sure we order the right kind of transcripts because we knew about it ahead of time, so we order the right kind of tax transcripts that don't show that job. Do you have any other properties that maybe don't have your mortgage, have any mortgages on them? You know, the bottom line is that there are going to be taxes and there are going to be expenses on those properties and they will end up showing up. Just bottom line is underwriters, they dig in, they find things, title companies find things, they do information digs on you. We want to make sure we know about those. And then, are there surprises with credit? Do you have tax liens? Is there something that's going to pop up when they do a confidential information statement that ties to you that shows? A good example is I had a situation where I had a client whose son had gotten into some trouble and she got hit with a lien through the county because she was one who signed for him because he was a minor at the time. And so she actually had to pay off a lien in order to qualify for the transaction. It was a kind of a fringe situation, but make sure you address those things up front. Make sure you let your lender know about them up front as well. And a lot of these surprises, the most frustrating part about it from my world and from your loan officer's perspective is that if we knew about them ahead of time, they're not as big a deal. It's just when you get down to the wire, you get down to that time where you crunch time, you need to close the loan, that they become problems and they become bear traps because we have to scramble to try to fix them and try to address them. So just make sure that you communicate with your loan officer, be upfront with them about, hey, this is the situation, here's the properties I have this side job, all of those sorts of things. That way they can address them up front and solve them before they become problems. One thing I do once I have my clients fully approved is I send them an email that breaks down all the do's and don'ts for the home purchase process, and it covers these mistakes so they know what to avoid. These 5 mistakes are by far the most common reasons why loans get declined while in process. Now that you know them, you can easily avoid them and make your home purchase as smooth as possible. Be sure to like and subscribe for more tips for home buyers, and if you have any questions, drop them in the comment below or shoot me a call, 619-249-9140.